Hey everyone, welcome back. Ready for another deep dive?
Definitely.
So it's this English learning podcast called Daily Money Briefing.
Huh. Interesting. Okay.
It's actually pretty cool. You get the
Yeah.
financial news and kind of a language lesson all in one.
Oh, I like that. Sort of killing two birds with one stone.
Exactly. Today we're untangling three big financial stories that are actually quite connected.
Yeah, definitely connected. We've got the U.S. Fed's latest rate decisions, let's say challenges for South Korean insurers.
Right, and then this sudden, maybe unexpected optimism in the Korean stock market.
Exactly. It's a great snapshot of how global money moves.
And our goal here is to help you see that bigger picture, how these different pieces interact without getting bogged down in jargon.
Okay, so where should we start? The Fed.
Yeah, let's kick off there. So the U.S. Federal Reserve, they've held interest rates steady. Again,
Third time now. Keeping that target range between 4.25% and 4.5%.
which is interesting because, back in 2023, they cut rates quite a bit, right? Like a full percentage point down from
Right.
5.25%.
They did, so why hold now? Well, they're being cautious.
Cautious about what specifically?
They seem to want to observe the impact of trade policies, tariffs,
Yeah.
see how those play out in the economy first.
Before making another move. Okay.
Right. Plus, you've got that background noise, the reported pressure from former President Trump pushing for rate cuts.
Ah, yes. That adds another dimension. And crucially, this leaves a pretty big gap between U.S. and South Korean interest rates, doesn't it?
It does, about 1.75 percentage points. And that gap, it matters quite a lot for our next story.
Which brings us neatly to South Korea and its insurance companies. They're facing a bit of a looming, well, maybe crisis is too strong, but a definite challenge.
A crunch, maybe it's tied to these 20-year government bonds they bought way back.
Right. Bought like 2 decades ago, mid-2000.
Exactly. And back then, the yields were pretty good, around 5%. Insurers snapped those up for stable long-term income.
Makes sense. But the problem is those bonds are maturing now.
Precisely. And current yields on similar safe investments like government bonds, they're way down, maybe hovering around 2%.
Ouch. So going from 5% return to maybe 2%, that makes reinvesting really difficult.
Incredibly difficult, especially when you need to match long-term liabilities and that 1.75% U.S. rate gap we mentioned. It just makes finding attractive domestic yields even harder for these Korean companies. They're kind of forced to look elsewhere, maybe riskier assets.
So these bonds, they were originally issued back in 2006 to help with government finances.
Yeah, part of stabilizing fiscal planning back then. Now it's creating this reinvestment headache for the insurers who bought them.
Okay, so the low yield environment, partly linked to what the Fed is doing, puts these insurers in a tough spot. How does that connect to the stock market being upbeat?
It seems a bit separate at first, but let's look at the KOSPI, the Korean Stock Market Index. There's definitely renewed optimism.
What's driving that?
A key factor appears to be the Korean won. It's been strengthening.
Ah, the currency.
Right. And when the won strengthens, foreign investors often take notice. We saw just the other day, foreign investors bought a net 374 billion won worth of Korean stocks.
Wow. Okay. That's quite a reversal from earlier this year. Wasn't there a big sell-off?
Huge sell-off, something like 18 trillion won earlier in the year. So this is a significant turnaround.
And why does a stronger one attract them? I mean, I get it makes imports cheaper, but for stock investors,
Well, think about it from their perspective, say, holding U.S. dollars. If they invest in Korean stocks and the stocks go up, that's one win.
okay.
But if the won also strengthens against the dollar while they hold those stocks, when they eventually sell and convert back to dollars, they get an extra boost from the favorable exchange rate.
Ah, I see. It's like a potential double gain. Makes Korean assets more attractive.
Exactly. So that stronger one acts like a magnet.
And that's fueling talk about the KOSPI possibly hitting, what, 2,700 soon?
That's the optimistic projection, yeah. If this flow of foreign money continues, driven by the currency strength.
Okay, let's quickly recap. The Fed holds rates, maintaining that U.S.-Korea interest rate gap. This makes life harder for Korean insurers with maturing bonds needing reinvestment in a low-yield world. But at the same time, a strengthening Korean won is pulling foreign investors back into the stock market, boosting the KOSPI.
It really shows how these different financial currents influence each other across borders. U.S. policy impacting Korean bond yields, currency shifts driving stock flows.
While interconnected. So a final thought maybe for you listening. How might something unexpected, another global event, a sudden policy shift in the U.S. or Korea, send ripples through this whole system?
Yeah, it really highlights how dynamic things are. Understanding these links is key because things can change fast.
Well, that's all the time we have for this deep dive. Thanks for joining us.